For more on what's next for the markets, let's bring in CNBC contributor David Zervos. He's Jefferies' chief market strategist. David, great to see you. Great to have you on. What did you make of the market reaction? What does this tell us about the state of where we are right now in the markets?
Well, Melissa, I think, one, we're all trying to be, armchair geopolitical analysts, and none of us are particularly good at it. We lean on a lot of very talented people for their expertise. But even then, I don't know that there's voices that I think are 100% or even 80% knowledgeable on the next steps here. It's pretty uncertain. I actually think, given how high this has escalated, where we actually have Iran and Israel trading directly missiles between Tehran and Tel Aviv, something we all really haven't seen, certainly in any recent past. There's been proxy wars. The market was pretty resilient. Obviously, the close was a little bit sloppy, but in the grand scheme of things, a 1%-ish move, a little more than 1%-ish move, is not a particularly difficult market. The fixed income markets, as you guys were talking about a little earlier, probably more of a disappointment because people getting themselves lathered up on inflation. But I think that's probably where I see the market reacting more inappropriately, where there's opportunity. I don't think fixed income would be continuing to rally, or the yield would be continuing to rise significantly if this escalates more. So I don't see the reaction as a particularly negative one, is how I would answer that question, Melissa.
Yeah, I mean, we were discussing this sort of lack of reaction really on our own show call earlier today, saying, if if you told us yesterday what was going to happen today, we probably all would have guessed a sharper market reaction across the board, across assets, and we didn't really get that even when Iran retaliated. So does that give you more confidence about the markets and where we are right now in valuations?
It does, Melissa, and I think it fits into the narrative that we've been trying to convey to our clients over the last couple months, the tumultuous April and May periods, that there really was a sort of an emotional liquidation of U.S. positioning, risk asset positioning, and that really has set the market up for, as you guys said earlier in the show, one of the most amazing Mays, or at least end of Mays in modern recollection. So I think positioning is still actually pretty positive for the market, in the sense that people did shoot first and ask questions later. They got very twisted up on the tariff announcements, didn't really understand the negotiating tactics that were being used. I think there's a lot of positives that are coming out of that negotiation tactic, and we're going to see more of those. But more importantly than the positives from deregulation, a fiscal bill that I think will pass and has some pretty pro-growth features to it, and the trade negotiations moving forward. Even there, I just think people are not positioned for it. People have let their politically charged emotions drive a lack of risk asset positioning. And I think that's what we're seeing today. What we're seeing today is the market is not really overly committed to risk.